Hope everyone had a good lunch. I've already lost track of what day of the week it is. It is January 15th. It is 1:15. We are here in the Ways and Means Committee Room. And not, the wrong week's schedule. It is January 8th. Yes. Thank you for your help. I'm so glad you're here. Makes all the difference.
Yeah.
Anyway, it's 1:15 and we're gonna continue our work on the corporate income tax. With a combination of Pat and Kirby. Pat's listed first. Is that your desired plan of action? Great. Kirby, would you like to join us?
Yeah.
Well, thanks. So on Tuesday, we had an opportunity to sort of dive into the federal actions and how they're going to affect Vermont to some degree. Today, we're going to take a step back to what is our corporate income tax so we can better understand the relationship between the federal changes and our state level taxes. Which I think from a learning perspective might have been a little reversed, but I think from a impacts perspective, makes sense. I don't know. There's no perfect way to do things. Thanks for your patience, Kirby. Floor is yours.
Sure. I'm really hopeful. I mean, some stuff's going to stick today. I'm probably saying that because it's sticking for me finally.
So good.
You'll see what I mean in a minute. Because, Vermont had some large changes to corporate income tax a few years ago, and we have to psychologically get used to that. Okay. That was more dire than I finished. Okay. So Kirby Keaton, Legislative Council. I'm gonna try to hit some of the really high points, answer some of the questions that I've heard from folks in the building recently. And so I'm gonna try to focus on like an FAQ type approach. So we're talking about corporate income tax. And we're gonna start off by talking about entities that are subject to Vermont corporate income tax, because this comes up when we have these discussions. There are three. But we're going to start, because I do law stuff, we're going to start with the law. The definition of corporation in the income tax chapter states corporation means any business entity subject to income taxation as a corporation, and any entity qualified as a small business corporation under the laws of the United States. The part in red is the really important stuff. If it's subject to income tax as a corporation under federal law, we consider it subject to taxation. So Vermont currently piggybacks on the US tax code when it comes to taxation of corporations. So the three types of entities that flow through are US resident C corporations. Those are the ones that we mostly talk about when we talk about this. But because the question comes up, I did want to call out once and for all, hopefully for all, these other things.
Never for all.
Sometimes this stuff can get mixed up in our heads. Presentation I gave earlier this week, I mentioned S corps when I meant to say LLCs. So I want to correct the record on that one. It is sometimes LLCs that are taxed as C corps, and then certain nonprofit organizations. And I'm going to get into those three things. So the first is, what is a C corp? That question comes up a lot. A C corp is determined by the taxpayer when they go to set up and organize their business. That is the answer. They make themselves a C corp. There's many steps involved. I've put some of them here: filing articles of incorporation with a state, any state, appointing a board of directors, drafting corporate bylaws, issuing stock, and acquiring an employer identification number from the IRS. Those are all necessary parts, and there's more than that that goes into it. The point is that the business makes itself a C corp very intentionally, and then it pays taxes as a C corp intentionally. Okay. The next category was sometimes LLCs, right? So when do LLCs file a C corps? The answer is it's up to them. They elect to be treated that way. So there's no case in which Vermont or the IRS is making a taxpayer LLC subject to corporate income tax. It's when they choose to be, and it's when the tax treatment is favorable. I think we had a brief discussion last year about there's certain health for LLCs that have a lot of employees and they're paying for healthcare for those employees. That's one instance where it might make sense because you get a lot of benefits under the federal corporate income tax in that situation. So you would want to choose to be treated as a C corp. But it's really those niche situations, and it's a decision that an LLC will make with its accountant, whether it wants to elect to be treated as a C corp.
Many of them like bounce back and forth year to year.
That's a good question for the tax department because I don't follow that stuff.
I don't think it's permissible from a tax.
The election is for a certain number of years.
Yeah.
Can you look
I
at
can
that?
look that up. Yeah. Okay, nonprofits. This is the other category. Sometimes nonprofits are taxed as C corps when they have what's called unrelated business income. Vermont has a provision of law about this specifically in our corporate income tax statute. And the Department of Taxes has technical bulletin 59 that is exclusively about this topic. But just so that you're aware, unrelated business income is income from a trade or business regularly carried on by an exempt organization and not substantially related to the performance by the organization of its exempt purpose or function, except that the organization uses the profits derived from this activity. I don't know. We could make up a charity and say that charity runs a gas station. They use the money from the gas station for their charity. They may have to pay some corporate income tax from the gas station aspect of what they're doing. Okay, so that's it. So that is the tax base. Those are the taxpayers who potentially pay corporate income tax in Vermont. And as we said before, those are the taxpayers who potentially pay at the federal level too, because it's the same group in each case. So what is the tax base for Vermont net income? It's what we've been talking about for the structure of the corporate income tax. For Vermont, now we're talking about Vermont specific stuff. The tax rates, we have progressive brackets, marginal tax rates, and a minimum tax based on Vermont gross receipts. So that you're all aware, just hitting the high points here, the highest marginal bracket is 8.5%. That's the most that a corporation would pay at the highest level, marginal level. And it kicks in at income over 25,000. So relatively soon, right? We also have the minimum tax. So for corporations, they have to pay the higher of the two, whether it's using the tax brackets or the minimum tax. And under the minimum tax, a corporation that has over 300 million in gross receipts from Vermont, as in bringing in gross receipts or the income you bring in, all of it together with no deductions. The minimum tax would be 100,000. So that's the highest amount under the minimum tax.
Yeah. Thank you. You said from Vermont, but you don't mean only.
In this case, it's Vermont gross receipts, yeah. So once we have those things covered for a taxpayer, the next step is allocation and apportionment. And this is the parts that can get tricky and can throw us off. We'll be talking about the single sales factor, which is at this point in time, Vermont only looks at sales made into Vermont to decide tax liability for a taxpayer. Even I sometimes think of that wrongly. Sometimes I think about property or payroll. Those are the other kinds of factors. It's not part of it. It's just not. And so having everyone think of it that way is like, it's changed, and I get it, because I'm part of the folks who need to not think of corporate income tax in terms of a business that's located in Vermont. 'Cause
The
it's-
way I think of it, Kirby, is instead of thinking about it as, and like, I'm curious if this works, is instead of thinking about it as like the way of I know this is like tech, instead of thinking about it as the base is everything that you described, and then you figure out the amount of tax responsibility by the sales into Vermont, I think about the base as corporations with sales into Vermont.
Yeah.
And then I sort of think from there, and for some reason that like helps my brain more. Does that
Mhm,
make sense to you as like a way of almost defining the base?
mhm.
Okay.
That does make sense to me. Yeah, trying to train myself to automatically think of it that way. But I'm going to go through the steps of this allocation and apportionment. The single sales factor is part of it. So the high point things to know is first that Vermont requires what's called unitary combined reporting. Corporations are often parts of families, right? Groups of affiliated, related corporations. For our purposes, for Vermont corporate income tax purposes, that entire family, that entire group of affiliated corporations are all the one single taxpayer. And we'll get into this later, but if any one of them makes sales into Vermont, that whole group, that whole family of corporations is paying Vermont corporate income tax. So that's another thing to, like it's a conceptual thing to be aware of. So basics here, combined reporting, the term combined reporting treats affiliated companies like I was talking about that are part of a unitary group, is the tax terminology, as one entity for tax purposes. So that's combined reporting. Unitary combined reporting, adding unitary to it, means that multi-state businesses that are part of the unitary group and unitary combined reporting, as in submitting one tax return for the whole group, applies to multi-state businesses that are part of the unitary group and the portion of the unitary business that occurs both within and outside of Vermont, which is what I was just saying, or of the US borders, sorry. So that means that some foreign income is included in that too. Okay.
Wait, will you just go back and just sit first?
So this,
You don't have to say anything else.
okay.
Okay, thanks.
Okay, so unitary combined reporting, we've got that understood. Second is allocation and apportionment. The term allocation means when a C Corp's income is derived entirely from within Vermont, all of the C Corp's Vermont net income is allocated to Vermont. So that's when you use the word allocate. It's not most cases, right? But if there is a case of a corporation that only is making sales in Vermont, operating 100% entirely within Vermont, all of their corporate income tax would be paid to Vermont. It's allocated to Vermont. So apportionment is the slightly trickier one. And that's when there's a C Corp that is making sales into other places also, right? So when a C Corp's income is derived from both within and outside of Vermont, Vermont law apportions a corporation's income that is allocated to the state based on a formula. And what is the formula? There's one part to it. One thing that we look at.
Yes.
Sales,
Oh.
yes.
No, I meant it. Thank you. I was being sarcastic. Thank you for yelling.
And it's in bold right here. So Vermont only looks at sales into the state when apportioning net income to the state. We use single sales factor that came out of Act 148 of 2022, so pretty recent. Property and payroll are not factored in. So now that we know about allocation, based entirely off of allocation and apportionment. Apportionment's been based entirely off of sales into the state. How do you determine state jurisdiction over a corporation's income, though? We're about to find out. Vermont is, you've heard of the Joyce and Finnegan thing, but don't even worry about Joyce. That's not us. Vermont is Team Finnegan. We take the Finnegan approach to answering this question. A taxpayer includes all members of a unitary group when we're deciding the tax liability of the unitary group, the family of corporations. Say a group consists of 10 corporations, only one of them makes sales into Vermont. Under Finnegan, the Finnegan approach, all 10 of them are filing that tax return together. All of the income of all 10 of them is apportioned. And that apportionment is based on the sales of all 10 of them. So once one entity in the unitary group has nexus in the state, then the entire group has nexus and income from all entities is included in the apportionment formula.
But you're probably gonna get to this, so
Mhm.
just thinking about if you have a particular line of products that are sold in the state generating a certain amount of money, but that product line itself is not very profitable. And the other entities elsewhere sold as extremely profitable.
Mhm.
How do you determine what's taxable income and what's not?
You look at the entire group, but I think what you're getting at is because a small fraction of the business activity is Vermont, then it will be apportioned that way.
But does the profit and loss of each of those particular products matter? Or is it the total profit and loss and this quantity of sales?
It's the total profit and loss and the portion of it that is Vermont sales.
It doesn't matter if I'm selling products that I'm not making any money on in the state of Vermont. It's a matter of fact, is the total entity is actually making money.
Yes.
Very interesting. And conversely, if
And
the
conversely.
total entity is not making money otherwise, but they're making a ton of money in Vermont, they do not pay taxes on
They pay
the
less.
estate.
What they're selling in the state.
Yes. They're selling, I'm just thinking gross profit margin, not gross sales.
And those are, yeah, you don't want to, we do apportionment based on the sales.
Yeah.
So the income subject to tax is
Same percentage of their net income.
the other part. Okay. So we're Team Finnegan. That means the taxpayer includes all members of the unitary group.
Great time for diagrams.
Mm.
I find this a great topic for diagrams, which is not your bailiwick, nor should it be. It was not a criticism.
Yeah, I would be better. Yeah.
You're making Joyce and Finnegan jokes, and that's good enough for me right now.
Okay, some other things to know without getting into the weeds of it, but just the takeaways. 'Cause my point today is to try to hit the high level things for the takeaways only. There's two things that were recently repealed in Vermont, the 80-20 rule and the throwback rule. The takeaways for that, so that you're aware about how corporate income tax works in Vermont. Number one, Vermont does not exclude overseas corporations from apportionment, which is something that we mentioned a minute ago also. The 80-20 rule had to do with that, but we don't follow that anymore. So when it comes to the whole pool of income that gets apportioned, some of that is going to be overseas income potentially. The other thing that you should be aware of is that when a sale originates in Vermont, but the state in which the sale is made does not tax the income, that is, the sales being made from Vermont into, say, New Hampshire. And maybe New Hampshire is not the best example because they have business entity tax. I'm going to say Florida. there's no income tax being apportioned there. There's something called a throwback rule in which a state might try to tax that, saying, well, it originated here and no one's taxing it, so we'll tax it. Vermont does not do that anymore. Used to, but does not.
Yeah. Do we know what changed? When and why did they change?
Both of those were Act 48, right? I think people knew.
We did all of it.
Fair.
Nope, it was all part of the changes to corporate tax we made before Kirby's time, right?
Before my time in this position, yeah.
Not before your time on Earth, or even your time working on tax
Yeah,
policy.
not before, yeah.
Before your time in the chair. And so, we did everything at the same time, and some things sort of increased total revenue, some things decreased your total revenue, one comprehensive package. And tried to really focus on like consistency, reducing tax avoidance, fairness. Representative Maslin, do you remember what we were doing?
I am talking specifically to that.
Great.
In Ways and Means, we were looking at the various types of ways that we might tax or not tax. One of the things that we tried to do fairly consistency was have the net balance being increases taxes to Vermont. And particularly such that it would encourage businesses to locate here. And that turned out to be a mantra that we tried to follow and still do. We want to have businesses look at our tax codes and see that they'd be better off here than somewhere else. I'm sure that'll continue.
And I would say, I think that was like a real high value for a lot of the members of the committee. I personally don't think that corporations or people choose to locate or unlocate somewhere based on that state's tax code. But it is one of the factors, and that is something that was really important for a lot of people.
They make decisions.
Yeah, totally.
And I think we also wanted to make sure our corporations were not paying more than out-of-state corporations.
Yes.
So this really helped.
And so I think that is the takeaway. All these changes are within the same theme of, like all of these things in different ways move away from thinking of it in terms of corporations in Vermont being responsible for corporate income tax in Vermont. It really is about corporations, many of them elsewhere, making sales into Vermont. Yeah, that's all I have.
Thanks, Kirby.
No. So she's retired.
Sorry, I just.
I don't actually know if he has record. I don't remember.
I feel like without Joyce Finnegan is no fun anymore.
We talk about Joyce Finnegan.
I was gonna say, was it Joyce Finnegan or was it Joyce Ann Finnegan?
It's Ann Finnegan.
It's a comma.
So Joyce was my grandmother's name, so.
Yeah, she's.
How's that?
The floor is yours, whenever you want it.
For anyone who doesn't know me, I am trying to get my PowerPoint to work, and I'm also Patrick Churchman of the Joint Fiscal Office. So yeah, as the chair mentioned, we're going to take a couple steps back here, but I do want to touch on a couple of things, just I think repetition in terms of how we think about corporate income tax is really important because it's very complex. But again, so like Kirby was talking about, Vermont, like the federal government, treats taxes on net income / profit. We actually use the federal definition for what net income is. And we'll again sort of see something we saw on Tuesday, again today, on how that sort of all adds up and then subtracts out to get to those definitions. Again, there's sort of two characterizations to sort of what a business is and how they're treated from a tax perspective. There's corporations, and they're subject to the corporate income tax, which is what we're talking about today. And then there's all those pass-through businesses, the LLCs, partnerships, S corps, what have you. Of course, as Kirby mentioned, LLCs have that option to elect the Yeah, for these pass-through entities, the profits are divided amongst the shareholders based on their ownership percentage, and they actually claim those against their personal income taxes. So kind of not what we're talking about today, really. Yeah, if you were to change corporate rates, these pass-through entities would just not be bothered by it unless it's an LLC opting to be taxed in that way. Yeah, Patrick's still trying to get my PowerPoint to work. Let's stop sharing and then start sharing again. You seem to have frozen. All right, can we all see that? Great. So again, I'm just going to touch on something we talked about Tuesday about how we get to net income. C Corps are subject to the IRS Form 120. And really, again, like I said, this is how we get to the starting point for Vermont corporate taxes. It's very similar to the calculation of adjusted gross income for personal income taxes. We take these federally defined dollar figures and the calculations to get to those as our starting point for Vermont state taxation. So the 1120 is for C Corps. Just if you're curious in looking at forms, which I've been doing a lot of recently, S Corps have the 1120S. LLCs file a 1065 if they're opting to be taxed as a pass-through. And then sole proprietors, they're just entering that right into their 1040, which is what you all fill out when you do your personal income taxes with your, wages, whatever you have. Those pass-throughs provide each shareholder according to their percentage of ownership, what's called a K1, which they then take and put on their 1040 to file their taxes. So only C Corps, with the couple of exceptions that Kirby talked about, are going to be subject to what we're talking about today. And this is the 1120. You all saw this on Tuesday. This first section here is adding all the money that's coming into the corporation up to get to that line 11, which is total income. That is not our starting point. That is really just a measure of what's coming into the corporation. They do have this long list of deductions that they're eligible to take. Remember, everything we talked about on Tuesday with regards to corporations, all those things are found will show up in lines 12 through 27 until you get to line 28 on the form, which is our starting point. That's where that's the sort of the federally defined net income that we use as sort of the pre-apportionment. What kind of income are we talking about?
Okay.
Mm.
Can you talk about depletion in the deductions? Okay.
Okay, so depletion. One example I found of that has to do with like timberlands. So as you're chopping down the wood, you're depleting the resource, so that therefore devaluing the value of that sort of land that you have. There's some other examples.
Also different than depreciation.
So depreciation is more typically going to relate to capital stock, like a building or a durable good, like a machine.
Depletion of natural stock.
I believe so, but I should double check on that.
Right. Double check on that.
Yeah. And yeah, so like I had to look up like bad debts, what that is, things like that. So I've been spending a lot of time with the forms, and not all deductions that we've been looking at sort of fit in the line where I would normally think they would. But there's a lot of very weedy areas of corporate income that that's why the federal statute book is so thick.
And per things wouldn't necessarily be where we think they are, and things are weedy. Advertising, is that straightforward in the way that I'm thinking? One would think, when you say advertising, like ad buys, et cetera, et cetera.
You know, I haven't looked in depth on that particular line. Logically, that sounds like it makes sense, but
Well, we're not talking logic. we're talking
yeah.
business.
Wow. So yeah, as Kirby mentioned, in Vermont, so we've gotten to that starting point of the federally defined net income. We have this 8.5 marginal tax rate. I'll show you the whole bracket in a minute. It's a marginal rate above $25,000 in that income that's allocated to Vermont. It's all going to be part of that unitary group that Kirby was talking about. So if a subsidiary sells into Vermont, they have Nexus here, it's going to pull in the entire unitary group, which is sort of part of that Joyce conversation as well. And so pre to 2023, and this is the act that Kirby was talking about, we actually had a 3-factor formula based on payroll, property, and sales taxes. So if you were only selling into the market, your weights for payroll and property would essentially be 0, right? Because you don't have really a physical presence here, but you're still selling in. But by having the weights on that be 0, you'd be getting a sort of kind of discount when you compare it to a single sales factor. So yeah, and beginning in 2023, that's when we made the shift to the single sales factor. And I got a couple of, I guess they're kind of diagrams to help sort of illustrate that point. But one little nugget that I always find very interesting is that firms with 0 taxable income make up roughly 70% of returns. And so those are the ones that are going to be subject to the minimum tax, which is that even if your net income's 0 or below, but you've got gross receipts into the state of Vermont, you're still going to have to owe like some kind of taxes based on that schedule. So again, Vermont uses the US definition for taxable income for unitary groups within the US. C Corp's taxable income is apportioned to Vermont, and that's where the single sales factor comes in. And I will admit, I stole this graphic from a presentation Will Baker gave in here a couple of years ago because I thought it was very cleanly done. But this circled in red here, that is from the line 28 on the 1120 form that I was talking about earlier. So that is the starting point. And then this second little division equation here on the right, in the middle here, that's where you get into figuring out what percentage of the unitary group's overall net income is actually apportioned to Vermont. It's really just, it's really just kind of this sort of pro forma example I have here. The first 2 examples, example 1 and example 2, are sort of the 2 extreme ends of the spectrum. Both corporations have $1,000 in federal taxable income. This first one here has none of those sales going into the Vermont market, but they've got 5,000 sales in sales overall. Their apportionment to Vermont's 0. They're not going to be paying any. They're actually not even going to be paying minimum tax because their sales to the Vermont. There are no gross receipts here in this example. The second example, Corporation B, same federal taxable income, but they're only selling to the Vermont market and nowhere else. So really here it's just 1,000 times 1. Their entire net income is apportionable to Vermont and will be fully, subject to Vermont corporate income tax. And then example 3 is really just the middle of the road example. Half their sales are into Vermont, half their sales go to other states. So half of their taxable income is going to be apportioned to and subject to Vermont corporate income tax.
Would example 1, would they file a tax return at all in Vermont?
That's a good question. So another thing I find interesting is Vermont gets a lot of zero apportionment, 0 net income returns. So I think that a lot of corporations just kind of fill out a form for all 50 states just to kind of cover their bases and have the documentation there. So they don't have to, but a lot of them actually end up doing it. I think it's just to cover their bases. Yeah.
And we can have Taxon to talk a little bit more about some of this, like this sort of piece of the puzzle, if that's helpful. And the CPAs Association is having a lunch on the 22nd, which I imagine everyone got an email for, but it would be, I know some of us have very close relationships with accountants, but it's it's nice if all of us have more professional relationships with accountants.
Maybe married to one.
May or may not, may or may not.
So just, because we don't often spend time like sort of on the scale of forms in this particular way, and it's really helpful for us to be talking in this way. So I appreciate your digging, Pat, and thank you.
So before I move on, this is just sort of the torn down to its essence sort of explanation of how the apportionment factor and the single sales factor in Vermont works. And so a really important bullet I have here is that these are just completely agnostic as to where you're located. I think so if you assume corporation A is in Vermont, I think the hypothetical on Tuesday was we have one in Oklahoma and Arkansas. They're all sort of being treated very identically with this type of treatment. So.
Can I ask a quick question about where you go to look for data? So I had someone reach out to me, a constituent reach out to me the other day, say, I would like to know, like, how much tax Amazon pays in Vermont, for example. Where would you go to find their 1120? And where would you go to figure out how much of their sales actually happen in Vermont versus other places?
Okay, so I think there's kind of two things there. So I think there's a distinction probably to make between, well, sorry, let me back up again. So I would never have access to Amazon's Vermont corporate income tax return. The reason for that is it's kind of like an individual taxpayer on their personal income. It's sort of, it's personally identifiable information. I would presume, and I don't actually often look at this on a individual entity level, typically. Presumably their quarterly filings will include line items for things like taxes paid. I don't know that for sure. I'm sure you can get that from like the SEC, for example.
Yeah, the 10Ks and 10Qs though will have, their accounting income, which can be very
Yeah.
different than their taxable income.
Yeah.
For lots of various reasons. And that's where I got hung up because I thought, well, I know where to go to find a 10K or 10Q, but
Yep.
actual tax information is trickier because you can find a tax that they paid. The question is, what was the basis on which that tax was paid? And that might not match what's in the net income on their 10K, for example.
Sure, and part of what makes that also a little bit complicated is most corporations are paying their taxes on a quarterly basis in they're called estimated payments. So they'll be paying their taxes in real time, and you have to wait. They wait until sort of end of year or end of their quarter to sort of true up. One thing that a lot of them end up doing is they'll either, if they're owed money, they'll take a cash refund, or they can actually carry that forward towards future liabilities to whatever governmental entity they're having to pay the taxes to. But yeah, again, I don't really work on it on like an entity by entity basis. It's a good question. But and a lot of times there's a real dearth of information available. I don't know if anyone outside of maybe the tax department, but not even them, probably the IRS has access to the sort of what did Amazon claim in business interest deduction? They'll publish aggregate.
It's protected. It's like
Yeah.
very, very, very protected data by the government, right? Like
Sorry to take us off track.
No,
It was just
it's a really important
question.
question. And it's actually, it makes some of this work really hard because for good reason, like a lot of folks don't trust government with their information, right? For good, and so it makes it, and so tax information being particularly sensitive, we have all these protections built around it, but it makes it really hard for us to understand some of the impacts of what we're doing.
So Amazon can have my data, but I can't have theirs. Yes.
I mean, they don't have your tax data though. I mean, they might have your tax data.
Get your taxes done at Amazon.
Oh, there, yeah.
Back to you.
Okay. So, so we talked about the determination of Vermont taxable income and then going through the apportionment. This is what it eventually feeds into. We have the marginal tax rates here. You can see the bands for corporate taxes in Vermont are very narrow. Goes from 0 to 10,000, 10,000, 25,000, and then 25,000 and up. With that top rate being 8.5%. So effectively, especially for Vermont's big corporate tax players, their effective tax rate is about as close to 8.5% as you can get. And I will say that, you know, it's the few very large corporations that do predominantly end up paying most of Vermont's corporate income taxes. And so again, their effective rate is going to likely be much closer to that 8.5 than anything you see below it, because those bands are pretty narrow overall. And again, because we have a lot of zero or negative income filers in Vermont, what they end up actually having to pay in terms of minimum tax, you can see in that second table just below. So if they have 500,000 or less in gross receipts, it's just $100 in minimum tax for those entities.
Acknowledging what we just talked about with protecting information, do we know how many corporation C corps pay these different tax rates? Like, do we know how many C corps are being charged at 0 to 10,000, et cetera?
Oh, I've got some, I might be able to get it updated, but I have at least some older information that I can dig up from a couple of years ago and share that with you.
Even though it's no longer in effect, that it's already 80-20 rule at work. Which is
I think we did it.
20% of the corporations.
I remember, I think it was post single sales factor and all those other changes, but I have to double check that. And it could be something that the tax department might be able to update for me. So.
I would find that interesting too.
Sure. Yeah, I'll reach out. So that was sort of mechanics. Next, I was going to talk about just what corporate income taxes mean to the state of Vermont in terms of the budget. So the July 2025, and I know we're getting an update tomorrow, but the current
Next Friday.
Next Friday, thank you.
I, earlier, like
yeah.
just an hour ago, I did that exact same.
Yeah.
Anyway, weird.
So the July forecast, they were forecasting about 240 million in revenue, in corporate income tax revenue for fiscal year 26, the one we are currently in, which sort of shakes out to being about 10% of overall general fund available revenue. For context, personal income taxes make up about, I think it's 55% of total general fund revenue. It's so, and again, this is the second most important revenue source that we have for the general fund, if you don't include healthcare revenues. So it's a very large chunk of general fund revenue, which we use for almost everything except for areas.
Representative Bodie, you can always finish your sentence.
Sorry, I was just. Question. This 55% is personal income tax that goes out of the general fund. Makes up 55% of personal income tax makes up 55% of the general fund revenue.
Approximately.
So do you have statistics on how many of those who are paying personal income tax are in double income households? Where they, yeah, there's one question. How many of them are in single income households? And in both those cases, how many of them have children? And how many of them are making above the cutoff of 175 that we have for giving help to people who are
Child tax credit.
child tax?
So double income, single income with kids.
Either one of those. Anybody who has kids, double or single income.
I saw,
And because, and I don't know if you know this, but have you seen any trend of double income family since we enacted the child tax credit? Going from a double income to a single income family when they're above the 175.
so I can get some like single year snapshots for that. I think the truth is for looking at something like a trend. It hasn't been around long enough for something like that to have any sort of like statistical significance to it. So, but one thing that is on the JFO website is a year or two ago, after the first year of the child tax credit was enacted, there's an issue brief on there that talks about number of kids, number of claimants, which would be the number of households, and a couple other things, including like overlaps with other state credits like the EITC and child independent care credit. So I can send that to maybe Sorsha or directly to you if you want.
Sources.
I'll send it to Sorsha.
The brief is
I
up.
ended up,
The issue brief, yeah.
I'm concerned about people who don't qualify for the child tax credit.
Representative Odie,
Yeah.
I appreciate that. And we're talking about corporate income right now,
Yeah,
which is,
worried about the general fund, but okay, that's fine.
okay.
I just thought you'd want that.
Okay, let's go back to corporate income because you're on personal income.
Yeah, so the last thing I'll say about personal income for right now is that it's been holding pretty steady up against the forecast. So there hasn't been any concerns in that area. So
After the e-board meeting, we'll do lots of delightful presentations about that.
Yeah.
Tom will have lots to say about it. So
Or just.
All of it. It'll be like the standard post e-board revenue conversation. Yes.
So yeah, it's about 10% of forecasted general fund revenue for fiscal year 26. Just a little perspective, last year, corporate tax revenue was approximately $272 million. So this year's forecast did represent about a 12% decrease in total revenue from the source. I will say, September last year, we had a very large one-time event. Usually the one-time events surround mergers or acquisitions or what have you. So if you were to strip that out and just talk about the baseline, it doesn't look as scary as a $30 million drop right now in terms of, what's going on.
Sure, what
Yeah,
happened?
represent was it?
What happened last September?
Oh, so I don't, again, that's sort of the private information that
Oh, okay, okay,
I'm
you
not allowed
weren't
to
being
know about.
coy, you just.
No, but Tom Corbett does have he does have access to that sort of information. So in very vague terms, he'll tell me things like
Yeah, yeah,
at one-time event,
yeah, okay.
Stuff like that. So yeah, the July forecast had that initial decrease from the prior year in corporate income taxes, but if you look at the chart, it does show sort of gradual, steady growth moving forward. I will say in the first 6 months of fiscal year 26, corporate income tax revenue has been below the July consensus forecast by about $25 million. Corporate income tax revenues are, my understanding and given my conversations with the state economist, below target, largely due to refunding activity that happened in November and December. If you remember, I don't know if it was 10 minutes ago or whatever, we were talking about how corporations sort of account for the taxes that they are paying. Usually when they are eligible for a refund, they can either take the cash or defer it and roll it forward. It's called carry forward and apply it to future liability. In this instance, some of the larger players have been opting to receive those refunds in cash rather than to defer them moving forward. Again, that's something Tom has very specifically been looking at for the forecast should be getting next Friday. And yeah, so I think that's one thing to keep an eye on, certainly, and maybe something to sort of pay attention to in terms of whether it's maybe a little more systemic or is due to some discrete events that have occurred amongst a smaller cohort of these taxpayers. And yeah, so corporate income tax revenue is still seen to, moving forward, probably account for about 10% of general fund revenue, still to be a very important component of the general fund in future years. And I have a chart here, which shows sort of historically what corporate income tax collections have looked like in the state of Vermont. You can see a lot of very steady growth. And then right around when the pandemic occurred, we see the spike here actually. So in that time period, corporate income revenue went from about 7.5% of the general fund and jumped at its peak, and it looks like fiscal year 23 to about 12.6% of the general fund. Last year, I think it was about 11%. We're back down to forecasted about 10% of general fund revenue. But one thing I want to show here is a lot of peaks and valleys in this sort of progression. And actually, why don't I show you this next slide here? Because this shows you from year to year how much corporate income tax jumps around. It's a very volatile tax type. And so just what this chart is telling you here is on the left, you have percent change from the year prior, and then just on the bottom of the fiscal year. So anything below that line shows a decrease from the year prior, anything above is an increase. And it's very spiky. It's very lumpy. It's really difficult to look at from a month-to-month basis because typically it either all comes in at once or all goes out at once. And so I guess really what I want to sort of hammer home with this graphic here is that it's a very volatile tax type.
And when you say corporate income tax collection in terms of this chart, this is dollars collected, not amount of tax returns filed.
Dollars, yeah.
Yeah.
This is
Percent change in dollars.
In dollars, yeah.
yeah.
Will you go back to the one big?
Sure.
So single sales factor was 2023.
It was also the pandemic has a lot going on here.
Feeding a lot of.
Yeah.
Which is what's sustained. I mean, ostensibly, you'd say there was a shift in who was paying the corporate income tax with the adoption of single sales factor. Although we're not comparing names as to who's on that sheet and who's not on the sheet.
Yeah, well, the US economy in general is a very consumer-based economy.
Yes.
People had a lot of money that was coming in, household savings really went up a lot. People were buying a lot of stuff during that time. So that helped with corporate profitability. They had a lot of customers who were able to spend money. Of course, not true for all industries. Tourism, entertainment, obviously not coming out of that in the best of places, but people had money to spend and not, especially with quarantines, not a whole lot else to do. So that is probably part of the spending spike you see during that time period that led to a lot of that profitability.
The overlaid sales tax on the same graph would it parallel?
I doubt it would be as spiky. Right. And part of the reason is, a portion of the reason has to do with how many exemptions we have on sales tax items, particularly things like groceries, sort of basic necessity type items. But, people might have been buying a lot more TVs,
Yeah.
what have, just items like that are subject to it.
Sourdough starters.
That's right.
Yeah. So very spiky, very lumpy, very volatile. And when comparing Vermont's sort of tax regime or tax policy around corporate income tax to other states, 44 other states have a corporate income tax. 15 of these, including Vermont, have brackets, so different marginal rates based on the amount of net income you have. And then just the remainder have a flat tax. Apportionment factors and determination of net income across states differ. I will say Vermont's coupling to the federal definition of what net income is does simplify a lot of things if in terms of administration. You know, you look at a state like California, much bigger Department of Revenue over there, much more complicated forms, but they have the staff to really implement all of that. So that's a state that I do look at sometimes and say, well, they've kind of created their own sort of tax code, right? And they don't rely on the simplicity of linking up to the federal tax code in a lot of ways. And that's, you know, that's policy decisions, right? So yeah, if we look at Vermont's top corporate rate, it starts at 25,000 of net income. And then I have California, Delaware, Illinois, Minnesota. I have their rate, their brackets don't line up the same, but if you look at 25,000 of net income, these are the states that have higher top marginal rates than Vermont. And then there's a chart that you can also look at to look at all the other top marginal rates. I will add, top marginal rates do not tell the full story. Yeah, I like to include this, just look at corporate profits nationally. Again, this is similar to what you saw in the slide about tax collections. One thing I will note is that you see this run up, the spike in this particular chart about a year or two prior to when you see it in our tax collections. Oftentimes corporate taxes take a little bit more time to flow through compared to when the profitability is sort of, you know, with the shareholder quarterly financial reporting that the corporations have. It's not too dissimilar to you earn your income in 2025 and file your taxes in 2026, but it's a little bit, it typically ends up being a little bit longer of a process of sorting all that out with all the complexities.
Patrick,
Yes.
when do the corporations file their taxes?
They have, so they'll have their own, fiscal years often, right?
Mhm.
They will have the usual April 15th deadline that personal income tax filers pay. However, it kind of comes back to the question of, do we want the cash refund or carry that forward? So it's a little bit more of a rolling basis than you would think about for your typical personal income tax filer. So but there are, you know, there's 4 months that we look at too, usually each year, which is when estimated payments are due in Vermont. I believe December was actually one of them, so a large portion of those estimated payments coming in that month. Yeah, so it's a little bit more of a rolling basis, especially for the large payers. Probably less so for smaller corporations.
So I'm
Representative Wasserman.
gonna ask a multi-chart question. So on the last two charts that we have from Fred, from 22 to 24, you have corporate profits going up and you have federal corporate tax collections both increasing. But then if you go back to the scary blue chart of percent change in corporate income tax collections in Vermont from 22 to 24, that dramatically decreased. Is that due to the amount of sales that were happening in Vermont? Or is that a product of apportionment? Like federal tax
Yep.
collections are going up, corporate profits are going up, but we collected significantly less revenue.
Yeah, so there could be a couple of different things going on there. One thing is the feds don't have to worry about apportionment, obviously, right?
Right.
So there's not going to be any change in terms of when single sales factor comes in. And honestly, not just single sales factor, but the other corporate sort of tax law changes that were made in Vermont at the time too, like Kirby mentioned, the throwback repeal, the 80-20 rule, shift over to Joyce. So there's definitely, that could definitely be a portion of it, but also the national market's not the Vermont market.
Right.
It's not a mirror image, I guess is kind of what I'd say to that.
Yeah, I just think you know, coincidence is the wrong word, but it's just interesting to me that Act 148 went to effect in 2020 and we have the flipped mirror images. Just curious to dive more into that.
Yeah, and part of that could come down to sort of maybe sometimes the split between what types of goods or services different states are consuming more of at any given point in time. Vermont is an older state. We do tend to consume more services that on a per capita basis than some other states do. So it can kind of, the industry mix that is important to a particular state can change as well. So I have in the next few slides the tax law changes from 2022, which I know Kirby went over, but we can go over again if you'd like.
Yeah.
Yes. Okay. Okay. So these are the 5 things that were in that bill, 148. So you had the repeal of the 80-20 language, the shift to single sales factor, the Joyce to Finnegan methodology, the throwback rule repeal, and the minimum corporate tax, that schedule we saw earlier. So again, the repeal of the 80-20 rule. Previously, if a C Corp had a subsidiary whose primary source of sales came from overseas, defined as that 80% of total sales or more, it was excluded from the sales of the parent C Corp. So Act 148 repealed that language, which said even if you're 81%, 82% of your sales are happening overseas, we're still going to include you in the unitary group when we're thinking about what your total sales and what your total net income is. The single sales factor, which we talked about, we don't care about your payroll, don't care about your property. We only care about what you're selling into the state of Vermont in the context of your overall sales. The Joyce to Finnegan methodology. So Vermont, we previously used Joyce, which limited a C Corp's nexus to Vermont only to the subsidiaries that had a nexus in Vermont. And when you think about nexus, there's 2 types. There's a physical. You have a physical imprint or footprint in the state. There's also something called an economic nexus, which I think the threshold for triggering that is like 100,000 in sales or 200 individual transactions, something like that. So if you had a subsidiary that broke either of those thresholds, the entire unitary group was pulled in. And yeah, so this change also is something that's affecting the apportionment formula for corporations because of what parts of their unitary group they need to be including in the determination of sales and net income. The throwback rule repeal. So previously, as Kirby said, if a C Corp sold into a state, which had no nexus and therefore no taxability, it was required to count those sales as Vermont sales. And I have a chart from the time that this was all done showing how it was sort of not the most significant of the changes made. I think part of the dynamic that changed a little bit about this does actually tie back to the Wayfair rule, which previously it had been very tied to if you have a physical nexus to a state. That Supreme Court decision did sort of say, well, you don't actually have to have employees or a warehouse here. If you sell into the state enough, you have nexus, they can tax you. With the regards to sales tax as well. Okay, and the last change was those minimum corporate taxes. This is that same schedule again. Yeah, so this actually happened in my first session here, and Graham Campbell was the one working on it. And I remember the way he sort of talked about it was less so it was more of a modernization of Vermont corporate income taxes. A lot of these changes were actions that a lot of other states were sort of embarking on around the same time. And you can see here that it was ultimately sort of designed to be sort of a net neutral shift in terms of total tax collection. It wasn't meant to really raise taxes, but sort of change the treatment of corporations in Vermont. And I think I heard some of the discussion about why some of those changes were done earlier, so I
Appreciate
don't
that.
need to rehash all of them. But,
No, it's helpful. Thank you.
and then just questions.
Do you have a question?
I do.
Cool.
Aside from what Teddy was asking about, how many corporations, Representative Watts said, how many corporations fit within those different categories? How big of a base are we talking about? Number of corporations who filed? Oh, do you have a,
I don't have the number off the top of my head, but I can get that.
249, it's 249.
And you want the number of CIT filers?
That would be good to know. I mean, not just not. Yeah, I have no idea.
And at the time that we looked at it last, that was where that 70% who were reporting zero or negative
Yeah.
came from at the time.
So just like piggybacking off of that, I think, like, it would be interesting, how many filers are there? Which buckets are they falling into in terms of minimum taxation, which bracket they're in, et cetera? As much of that is
Yeah,
possible.
I will say at the time that we passed the minimum tax, there were 10 tax filers that fell into the highest bracket.
300 million or more.
Yes.
Yeah, right, that's surprising. Yeah.
Surprised.
I was gonna say, it's right. Minimum tax of 100.
That's the only number from all of the psychometrics. Any other questions? Okay, that was a lot to digest, folks. So we are done for the day. Enjoy the floor. See you back here tomorrow at 9. One of our colleagues will be here presenting a bill.